The world of banking is as hated as it is misunderstood. Oftentimes, people would blame banks for macroeconomic problems like the ever-increasing debt level or for fueling the ever-increasing wealth inequality. And while that is partly true, it's far from the whole story. This is an important point as banking is a crucial concept that I believe most people need to understand way beyond what the news will tell you. Because when done right, banking can do a lot of good to the economy and to people's everyday lives. Take, for example, the ability to store your money in a safe place with a guarantee that the money deposited will always be there anytime you want to use it. Moreover, the banks will pay you for it. You might be surprised how in ancient times, people would spend fortunes just to keep their money safe and secure. Not to mention the ability to borrow money from an institution with a developed and regulated lending parameter that we've taken for granted. This is why we can get a product as complicated as a mortgage with only 2 to 3% interest rate paid over 20 years. Banking is complicated, but its basic concept is really simple. Banks store money from people that want to keep it safe and have more than what they can keep in cash in the form of deposits. They keep about 10% of the money as reserve requirements, and then they lend the rest of the money to people who need them to buy a home or starting a business. In other words, banks are financial intermediaries, or in layman's terms, we can call it a middleman. As you can see, this is a significant role as banks are the backbone of most economic activities. Good economies need healthy and productive banks. But here comes our first major problem. If banks are just a boring middleman, then how can these institutions become the world's wealthiest and most influential companies? After all, they're just a middleman. Sure, they provide valuable services and should be well compensated for it, but the fact that they've got so much money and power cannot be explained by our simple little concept. It's clear that we're paying so much money for a mere middleman. There's a short answer and a long answer to this question. The short answer is that banks are not just a middleman. At least, that's not how they actually function. And this concept that I've just explained is all wrong. To understand why, we need to dive deep into how banking actually works. So, to understand the problems with banking, perhaps the best way to explain it is just to give you an idea of how banks can create money. And there are actually 3 types of money circulating in an economy. The first one is physical currency, like cash and metal coins, which can only be produced by the Fed through the US Treasury. The second one is bank deposits, aka the numbers you see in your bank account. And the third one is central bank reserves, which can only be used between banks. For now, let's ignore the third category. The reason I said that this concept of banking is wrong is because banks don't actually lend people's deposits. Instead, banks create money and turn it into a deposit. I know this sounds a bit weird if you're hearing this for the first time, so let's just look at an example. Let's say you want to buy some furniture, and you come to the bank for a loan worth $10,000 and the bank approves it. You are given some paperwork that you most likely don't even read, and you need to sign a contract. The moment you sign that contract, 2 things happen. First, for the next several years, you owe the bank $10,000 plus interest that of course, you need to pay back. Second, the bank creates a record that it owes you money and immediately credits your bank account with $10,000 that you can freely spend. And at that very moment, the bank just creates money out of thin air. They didn't transfer any money to you, they just increased the numbers in your bank account from a computer. The numbers you see in your bank account are what people most often refer to as money, because this type of money actually dominates the economy. It is estimated that 80% of all money available is this bank deposit, or people sometimes call them credit. It basically means the same thing. But how do banks create money out of thin air? Well, I think the best way to explain this is by describing a little bit of banking history. Banks first originated from goldsmiths, which were tasked to create gold coins for trade in ancient times. At first, their jobs were just to mint gold into coins. But gradually, people became aware of the weaknesses of gold as a currency. It was risky to keep on hand, and you couldn't carry too much of it. These problems were solved when goldsmiths began storing people's gold in their vaults for a fee. The goldsmiths got a new source of income, and people were more than willing to pay these fees as long as their wealth remained secure. The magic happened when some clever goldsmiths found a way to make a lot more profit by creating gold that did not exist. You see, in exchange for people's deposits, goldsmiths would write notes detailing the amount of gold on deposit. By bringing this very note to a goldsmith, you can exchange this piece of paper with real gold. And people started to trade these notes as if they were gold, because it was way easier to carry these notes than carrying a pouch of coins, and it could represent a larger value. This is the origin of modern-day banknotes, where the value represented in paper money is much larger than the value represented in metal coins. But now, it is a common misconception that goldsmiths just started to lend their gold deposits directly, because they found a much better way. Instead of lending gold directly, they can just create more gold notes. In other words, they created gold out of thin air. If they had about 100 kilograms of gold in reserve, they could create about 5 to 10 times worth of gold notes. And people trade these notes as if they were real gold, because they represent the value of gold. So, the goldsmiths can collect interest on gold that did not exist. At least until too many people came to the bank and tried to exchange all of their notes for gold all at once. Because then, the goldsmith would be completely broke. The same thing happens with modern day banking. The moment someone makes a loan, money is created. And remember that I told you at the beginning that banks keep about 10% of the money as reserve requirements? Well, that's also wrong. There are no reserve requirements anymore. As of March 26, 2020, the Fed has reduced reserve requirement ratios to 0%. Now, if you're still confused, don't worry. It took me a week of contemplating just to make sense of any of this. Because banks really like to make things complicated. So, if you're interested, I'll link my sources in the description below. After all of this, you may think that the whole economy is a scam or banks are evil, yada yada yada. But some of the most prudent of you guys may ask, what is the problem with any of this? And you're right, the fact that we have had strong economic growth and an increase in standards of living in the past 100 years can be partly attributed to this very mechanism. Although it did allow for economic crises like the Great Depression and the global financial crisis to happen. The root of the problem with banks is in their concentration and capital allocation. The two issues that I'm going to highlight are all related to this. Banks are not just a middleman. They are the creators of the money supply. So, they have a special privilege in the economy to create money and allocate it as they see fit, which will have a long-term economic impact depending on whether they use this privilege wisely or not. Banks who use this privilege wisely can be extremely helpful to the economy. They can help people reach financial stability by owning a home or getting funding for businesses that will provide goods and services that will benefit the economy at large. However, banks who use this privilege recklessly and without any accountability can practically destroy the economy. They can fuel the ever-increasing wealth inequality and makes it even worse. They can fuel asset price bubble that by itself can create an economic recession, and they can cause instability and uncertainty in the system, which makes it understandable as to why banks are so hated by the general public, especially after the global financial crisis. The first major problem with banks is maybe the most obvious one. A few banks have gotten too big, so big that they're deemed too big to fail. And As we have seen in the global financial crisis, too big to fail banks will tend to take risky bets and speculations that could harm the whole economy, because they will receive assistance if their bets go bad. In other words, they lack the accountability to make wise decisions. This problem is also exacerbated by the bigger appetite of banks for creating money to fund financial transactions that provide less economic value than if the money is used for business investment that will provide the creation of new goods and services. In a situation of asset price euphoria, like the early 2000s housing bubble, it will be driven mainly by bank credits for financial transactions. The moment it stops, asset prices fall. Then you get the first bankruptcies, the bank goes risk-averse and stops lending money, and the whole thing crashes. The second problem is still related to the first one. The banking system has become so big and consolidated that they are uninterested in providing their services for a particular segment of the economy, mainly small businesses. If you are someone whose income is not gained from a regular salary, you may have found how hard it is to get a mortgage. With the automated system of credit scores, it is a hassle for the banks to examine the creditworthiness of a small business owner. Similarly, big banks will have a bias for wanting to deal with large customers to do large deals, because that's how the bank can get large profits and the bankers get large bonuses. This is a shame for small businesses, as they are an important part of the economy. If banks only focus on big projects, the economy will become much more centralized, and the local regional economy will be neglected. This problem is especially relevant in the US and UK, in which 4 or 5 big banks account for 80 to 90% of the entire banking activity in the country. So, what is the solution? According to Professor Richard Werner, one of the most prominent critics of the banking system that pointed out all of the problems that I've just mentioned, the solution is actually quite simple. Break up the big banks and have localized small banks to dominate much of the banking activity. He pointed out the case of Germany as an example. In Germany, about 70% of the banking activity is done by small localized banks and credit unions. Small banks have several advantages over big banks because they are localized. They knew a lot better about the local economy and would be more equipped to grant loans to small businesses, thus eliminating the second problem entirely. And according to Professor Werner, small localized banks are usually not interested in speculative credit. This was actually proved true in Germany, where in 2008, it did not have a credit bubble unlike most major economies, thus severely reducing the impact of downturns in the economic cycle. But he also pointed out that this solution is very hard to implement, if not impossible. In countries where big banks hold the majority of the banking activity, they usually have a lot of political influence. And as for small banks dominating the banking system, the moment they get bigger, they will be acquired by one of the big banks anyway. So, it seems like we are at the mercy of big banks having the power to create money while not using most of it for productive purposes.